A phone call was made, not to a politician, not to the press, to the trading desks of Goldman Sachs and Morgan Stanley. The United States Treasury just asked Wall Street's biggest banks one question: are you ready to intervene in the yen? That question has only been asked a handful of times in the last 4 decades, and every time it has been asked, something moved: currencies, bonds, gold, silver. This is not a routine market update. This is the moment 2 of the world's most powerful central banks stepped into the foreign exchange market to manually reprice a currency. And the ripple effects are already reaching the price of physical silver. Stay with us, because what happens next could define silver's trajectory for the rest of the year. Welcome to Currency Arc Insight, where we track the hidden currents beneath global currency and monetary policy, and what they mean for those holding physical gold and silver. Late last week, a number appeared on trading screens around the world that had not been seen in nearly 40 years. The Japanese yen had fallen to levels against the US dollar that most economists thought belonged to a different era entirely. For the average person watching the news, it may have looked like just another line on a currency chart. But for those who understand how deeply currencies are tied to the global economy, this number represented something far more serious. It represented a warning sign that Japan's financial system was under real strain. To understand why this matters, it helps to step back and look at what a weak yen actually does to a country like Japan. Japan imports most of its energy. It buys oil and natural gas from other nations, and it pays for those imports in US dollars. When the yen weakens against the dollar, every barrel of oil and every unit of natural gas becomes more expensive for Japanese businesses and households. Energy costs rise, transportation costs rise, the price of everyday goods rises along with them. This is how a currency crisis quietly becomes a cost of living crisis for millions of ordinary people. Japanese officials could see this happening in real time. On Thursday, they made the decision to act. Japan's central authorities began spending tens of billions of dollars from their own reserves in an effort to prop up the yen and slow its decline. This is not a small or symbolic gesture. When a government spends tens of billions of dollars defending its own currency, it is sending a clear signal that it views the situation as an emergency, not a routine fluctuation. For many watching from outside Japan, this scene may feel distant, but it should not feel unfamiliar. The United States carries a debt burden that has now climbed past $37 trillion. The value of the US dollar itself is held up largely by confidence, by the willingness of other nations and everyday people to continue trusting it as a store of value. Inflation continues to erode purchasing power year after year, even by the Federal Reserve's own official target. In many ways, Japan's struggle with its currency is a preview of a much larger and more universal problem facing fiat currencies around the world. When a government issues unlimited amounts of paper money, that money eventually loses its ability to hold value over time. This is precisely why so many investors turn to physical assets like silver during periods of currency stress. Silver cannot be printed. It cannot be created with a few keystrokes on a computer. Its supply is limited by what can actually be mined out of the ground, which makes it fundamentally different from a currency that a central bank can expand at will. Many long-term holders of silver choose to build their position gradually, using a strategy known as dollar-cost averaging, rather than trying to guess the exact bottom or top of the market. This approach allows an investor to accumulate wealth over time without being overly concerned with short-term price swings in either direction. As Japan poured billions into defending its currency, the situation on the ground was already intense. But what almost no one expected was for a second major economic power to step into this fight. Japan was not simply defending itself in isolation. Behind the scenes, conversations were happening in Washington that would soon turn a domestic currency problem into an international event. Officials at the highest levels of the United States government were watching the yen's collapse closely. They understood that a currency crisis in Japan would not stay contained within Japan's borders. Japan holds a massive amount of United States government debt, more than $1 trillion worth of treasury bonds. If Japan were forced to sell off large portions of those bonds to raise cash and defend its currency, it could send shockwaves through the global bond market, pushing yields higher and creating instability far beyond Japan's shores. This is the moment where a currency story became something much bigger. Japan had already stepped in to save its own currency. Now, the United States Treasury was preparing to do something that had not been done on this scale in decades. It was preparing to step into the fight alongside Japan, and for anyone holding physical silver, what happened next would matter a great deal. Behind the walls of the United States Treasury, a quiet but highly unusual process was set into motion. Officials placed calls to the trading desks of some of the largest banks on Wall Street, including Goldman Sachs and Morgan Stanley. The request was simple on the surface, but carried enormous weight underneath. The Treasury wanted to know how much it would cost to buy yen right now. This is known in financial circles as a rate check, and it is not something that happens casually. A rate check is often the last step taken before a government actually enters the market to buy or sell a currency directly. When traders across Wall Street began fielding these calls, many of them understood immediately what it likely meant. For decades, this kind of coordinated action between two major economic powers had been rare. Currency intervention on this scale, involving both Tokyo and Washington working in the same direction, had not been seen in a very long time. Reports soon confirmed what many suspected. The Federal Reserve Bank of New York had carried out a transaction on behalf of the Treasury, selling euros in order to purchase yen. This was not a private trade for profit. It was a deliberate policy action, executed through some of the most powerful financial institutions in the world, designed to support a currency that was rapidly losing value. Around the same time, Treasury Secretary Scott Bessent made a public statement that added even more weight to the moment. He said clearly that the yen was substantially undervalued and that the level of volatility being seen in the currency markets was unhealthy. Statements like this from a sitting Treasury Secretary are not made lightly. They are chosen carefully because markets react to every word coming from someone in that position. By saying this publicly, Bessent was signaling to the entire financial world that the United States was prepared to act, and in many ways already had. This moment mattered for three specific reasons, each one connecting back to the price of hard assets like silver and gold. The first reason involves the US dollar index. When central banks actively sell their own currency reserves or dump dollars in order to buy foreign currencies like the yen, it places downward pressure on the value of the dollar itself. A weaker dollar tends to work in favor of precious metals, since silver and gold are priced globally in dollar terms. When the dollar cools off, metals often find more room to rise. The second reason centers on liquidity pressure inside the Treasury market itself. Japan is one of the largest foreign holders of United States government debt, owning more than $1 trillion in Treasury bonds. For months, analysts had quietly worried about what would happen if Japan were forced to sell off large portions of those bonds to raise emergency cash for defending its currency. A forced sale on that scale could push Treasury yields sharply higher and introduce real instability into global debt markets. This is not a hypothetical concern. It has played out before, and many who follow these markets closely remember how quickly bond market fear can move prices across every asset class, including silver. The third reason is perhaps the most uncomfortable to sit with. This entire episode proves, in plain view, that central banks are willing and able to manipulate currency exchange rates when they believe it is necessary to manage sovereign debt risk. This is not a conspiracy theory or a fringe idea. It is now a documented action, confirmed through reporting and public statements from a senior government official. When the institutions responsible for managing money are also the ones actively reshaping its value behind closed doors, it raises a fundamental question about what that money is truly worth. For those holding physical silver, none of these 3 points exist in isolation. Each one connects directly back to the forces that drive the price of hard assets over time. A weaker dollar index, growing pressure inside the bond market, and clear evidence of coordinated currency management all point toward the same underlying story. It is a story about fragility inside a system built entirely on trust and confidence rather than something tangible. What began as a currency defense in Tokyo had now become a joint effort spanning two of the largest economies on Earth. But understanding the mechanics of the intervention itself is only part of the picture. The next and more important question is how this chain of events actually reaches the price of silver sitting in a vault or a safe. That is where the real story continues. To understand how a currency intervention thousands of miles away can move the price of silver, it helps to look at one basic fact first. Silver is priced in United States dollars across nearly every market in the world. This single detail creates a direct link between the strength of the dollar and the price investors pay for physical metal. When the dollar grows stronger, it usually becomes harder for silver to rise because it takes fewer dollars to represent the same amount of value elsewhere in the world. When the dollar weakens, the opposite tends to happen. Silver often finds more room to climb. This is the exact mechanism now in motion. When the United States Treasury takes deliberate steps to hold back excessive dollar strength against major trading partners like Japan, it effectively lowers what many analysts describe as the hurdle rate for commodities and precious metals. In simple terms, silver does not need to fight as hard against a strong dollar in order to move higher. A softer dollar index removes resistance, and that resistance being removed can act like releasing pressure on a spring. Some may look at this and believe silver is guaranteed to rise sharply in the immediate future. That is not quite the full picture. There remains a real counterforce at play. Later this year, the Federal Reserve may choose to raise interest rates again as part of its own separate policy goals. Higher interest rates tend to strengthen the dollar, working directly against the very trend that currency intervention is trying to create. This tug of war between two powerful forces, one pushing the dollar down and one potentially pushing it back up, is exactly why markets rarely move in a straight line. Even so, many analysts believe the weight of dollar suppression from coordinated intervention may prove stronger than modest rate increases, especially if bond market stress continues to build in the background. This leads to a second channel worth understanding closely, and it involves government bonds rather than currencies directly. Currency interventions of this kind are often described by economists as emergency bandages. They calm immediate panic, but they do not repair the deeper economic imbalance sitting underneath the surface, which, in this case, is the widening gap between the policies of the Federal Reserve and the Bank of Japan. When emergency intervention forces bond yields to swing wildly, large pools of capital often begin looking elsewhere for safety. Sovereign debt starts to feel less certain, and investors search for something that does not depend on any government's promise to remain valuable. Silver fits that description closely, since it carries no counterparty risk at all. Nobody has to keep a promise for silver to remain silver. This is not simply a theory being tested for the first time. It is already playing out inside Japan itself. As the yen weakened rapidly, everyday Japanese citizens and investors turned toward gold and silver in record numbers, seeking to protect their savings from a currency that was quickly losing purchasing power. Domestic silver prices inside Japan, measured in yen, have already climbed to historic highs. This pattern tends to repeat itself throughout history. A currency that stabilizes or begins to recover, combined with inflation that refuses to fully disappear, often triggers a second and even larger wave of buying, as households and institutions alike move their wealth into physical bullion they can hold and trust. There is also something worth noting about how differently this instinct shows up around the world. In many parts of Asia, turning to gold and silver during times of currency stress is almost automatic, deeply rooted in culture and financial memory passed down across generations. The reaction in Japan should be viewed less as an isolated event and more as an early signal, a preview of the kind of behavior that tends to follow whenever trust in paper currency begins to crack. None of this guarantees an immediate spike in the price of silver sitting in someone's safe today. Markets are shaped by many forces working against one another at the same time, and short-term price action can remain unpredictable even when the underlying story is clear. What this transmission line does reveal, however, is a structural connection that is difficult to ignore. Currency intervention weakens the dollar's grip, bond market stress pushes capital towards safety, and households facing a shaky currency instinctively reach for something they can physically hold. Each of these threads leads back to the same place, and that place is the growing case for silver as a store of value in an increasingly uncertain monetary world. Once the immediate drama of currency intervention settles, a much larger question remains standing in its place. What does it actually mean when two of the world's most powerful central banks step directly into the open market to reshape the value of a currency by hand? This is not a small technical detail buried in financial reports. It is a clear demonstration that the modern monetary system is far more fragile than most people realize, and that fragility does not stop at Japan's borders. It touches every currency built on the same foundation, including the US dollar itself. At the center of this story sits a simple but powerful truth. Central banks can create currency out of nothing more than a decision and a keystroke. They can also intervene to prop up or push down the value of that currency whenever they judge it necessary. This is not hidden or illegal. It is a normal part of how fiat systems operate. Yet, normal does not mean permanent or unshakable. Every time this kind of intervention becomes public, it reminds investors that the money in their accounts holds value only because a government continues to say it does. Silver stands in sharp contrast to this. Nobody can create more silver with a policy decision or a wire transfer. Its supply is limited by what can actually be pulled from the ground, refined, and brought to market. And that process cannot be rushed no matter how urgently demand rises. This structural difference becomes even more important when looking beyond currency markets and into the physical world of supply and demand. Silver is no longer used only for jewelry and coins. It plays a critical role in solar panel production, electronics manufacturing, and the rapidly growing infrastructure being built to support artificial intelligence. Every one of these industries requires real, physical silver, and demand from these sectors continues to grow year after year. At the same time, global mine supply has struggled to keep pace. Even among the most cautious analysts, there is growing agreement that industrial demand is closing in on what mines are able to produce. This is not a short-term news story. It is a slow-moving structural trend that continues regardless of what happens in any single week of currency headlines. Given everything unfolding across currency markets, bond markets, and physical demand, investors are left with a practical question. What should someone holding physical silver actually watch going forward? 3 areas stand out clearly. The first is the US dollar index. As long as coordinated intervention between the Treasury and the Bank of Japan continues to place a ceiling on the dollar's strength, that ceiling tends to work in favor of precious metals moving higher over time. The second is the yield on the US 10-year Treasury bond. If ongoing intervention continues to create volatility inside the bond market, real yields could fall, and falling real yields have historically provided a strong tailwind for silver prices. The third is physical premiums and the size of the supply deficit. Daily headlines will always create noise and short-term distraction, but the underlying physical structure of scarcity is what tends to drive silver's price over the long run. This is the foundation that patient long-term holders continue to return to. None of this suggests that silver is guaranteed to surge overnight, and no one can predict every twist the market may take in the weeks ahead. Currency interventions like this one do not resolve the deeper economic tension between major nations. Instead, they tend to accelerate awareness of just how vulnerable fiat currencies truly are. That growing awareness rarely fades quickly once it takes hold in the minds of everyday investors. Taken together, the events unfolding across Japan and the United States tell a larger story about where confidence is beginning to shift. Whether or not this marks the exact bottom for silver, the broader case continues to build that the metal sitting quietly in vaults and safes around the world is being backed by something far more durable than any single currency intervention. It is backed by scarcity, by history, and by a trust that has outlasted governments for thousands of years.